Good afternoon, outliers. How y'all doing today? I got some news today that really grinds my gears. I'm not going to disclose that with you, but I'm in a mood. So we'll see how this goes today. Dave, good to see you. Mike's here. Dave's saying hi to Mike. Michael's here. Donna's here. Randy, where you been, my friend? All right. So let's jump over into our PowerPoint here and we'll get started. Welcome to the OVTLYR Trading Room. This is smart trading made simple. This is where we save time, make money, and start winning with less risk together as a team. And for those of you who don't know me, my name is Christopher Yule. I've twice been awarded top 100 people in finance. I was mentored by 5 of the market wizards, the best traders of all time. I've been successfully trading since 2009. But before we start trading, let's get into the lesson of the day. Okay, this is a really good one today. This is options trading basics explained for beginners. So be sure to take notes as we go through this. A lot of this is going to be super technical. Hopefully he broke it down in a clear and easy to understand way, but I'll interject where I can to try and help make it a little bit easier.
Confusing when first learning about them. So in this video, I'm going to teach you what options are and how to think about them so that they make sense to you on a deeper level. Now, the first concept that you need to understand before we move on to the more specific details is that options are traded against specific stocks. So when we talk about options, we have to talk about the options of a specific stock. So for instance, Apple and Tesla both have their own options that traders use to try and profit from the future stock price movements in those specific stocks. Now, unlike stocks, which are just shares of stock that are bought and sold, options have unique characteristics that we need to talk about before we get into the rest of this video. Otherwise, nothing's going to make any sense. So first and foremost, every option has an expiration date, which is the date that the option's final value is determined and the option can no longer be traded.
And it's important to note that because unlike stocks, options do have a finite date. In fact, let me increase this quality. I don't know why it's at 360. Options do have a finite date. So you need to have that move happen that you're looking for, bullish or bearish, in the time frame that you're looking for, right? That's something that can really take new traders by surprise, especially when you don't know what you're doing. Trust me, I've been there. When you don't know what you're doing and you end up placing trades that are expiring way too fast, right? Maybe you've heard of zero DTE options. Please don't do that. It is a really risky trade where you get basically all or nothing. And you may win 8 or 9 times out of 10, but that 10th time is going to take off, 10x what each one of your losers or each one of your winners is. So it's important to figure out what expiration date works for you. Now, it may change, right? Like for me, I like to go, I start at 21 days. I move, a week earlier or a week later, give or take. That's my ballpark there. That's my wheelhouse. Whereas Steve Burns, we talked with him the other day, he starts actually a week earlier, around 14 days, and looks in that area, right? And somebody else may try leaps. Now, a leap is a long extended, I forget LEAP, I forget what it means, but something way out in the future that may be 6 months, a year, 18 months, something like that, right? And so depending on your trading and investing style, you can have very different expiration dates to achieve the same outcome, right? You and I can both be bullish, but I may be more bullish short term than you are. So you may be going with leaps and I may be going with something that expires in 2 or 3 weeks. Hey, Michael, good to see you. Sebastian.
Now, most stocks will have options that are expiring anywhere from a few days away to up to 2 years away. Now, the next unique characteristic of options is called a strike price, which is the price at which shares will be bought or sold if the option buyer exercises that option. Now, I know this is confusing, but stay with me because everything is going to make complete sense in a couple minutes. Now, the last characteristic that we need to talk about is called an option contract multiplier, which in the simplest terms is the number of shares that the option contract can be converted into if that option is exercised.
And I know Mike asked this once in the Discord. It's always 100, at least in American style options. I've never seen a time where it's not 100.
Now, for the most part, most options will have an option contract multiplier of 100, which means that the option can be converted into 100 shares of stock if it is exercised. Now, at this point, you're probably wondering, if options are so complicated, then why do people trade them, and what's the benefit of trading options instead of just shares of stock? Now, probably the biggest appeal of trading options is that they can leverage your returns relative to a simple stock trade.
Yes. So one of the best ways that I can think of, let me log into my Tasteworks account and we'll jump into it. One of the best things that I can describe is you can buy a stock for 10 cents on the dollar. Now, that sounds crazy, right? Getting a 90% discount on every stock you buy. But I'll show you the math here in just 2 seconds. Let me log in. Okay, we'll go to Apple stock since that's what he's got pulled up here as an example. And this is the way I trade. Of course, it may be very different from how you trade, but I like to go deep in the money options. This is what the market wizards taught me to do whenever I'm looking to place trades. So we'll go to Apple, and we'll go to, we'll go to this January one here. That's 32 days out. So for example, if I wanted to buy one share of Apple right now, it would cost me $250. All right, so let's do some math on here. So if I want to buy one share, that'd be $250. All right, but with the deep in the money option, I can get 100 shares, and that'll cost me how much? Let's see. If I go with like 80 deltas, generally where I go, it costs me $17.70. $17.70 per share. So it's it's this times 100. Right. So it cost me $17.70 to get into 100 shares, whereas this would cost me 25,000. So it's even less in this case. Let me move this over to get into 100 shares. Right. So imagine that these are real dollars here. So this divided by this means actually I would get a 93% discount by buying one option contract versus 100 shares of Apple at $250, or I could have 100 shares equivalent with one option contract at $1,700, right? That's a really cool advantage that options have that you can't get in a regular stock, right? You may be able to get it for half, right? You may be able to do this if you're using margin, but even that is still, that's still 85% less to go with the option, 86% less to go with the option versus buying the stock outright. So it's a pretty awesome thing to be able to have the leverage on options if you know how to use it correctly.
Trade. So let's go ahead and compare a hypothetical stock trade and an option trade to illustrate this point. So let's say we buy 4 shares of a stock for $150 a share and sell them 30 days later for $160 a share. Now, of course, this is hypothetical, but the profit on that trade would be $40 since we bought 4 shares of stock and they increased by $10 per share. Now, a $40 profit on a $600 investment is a 6.7% return. So let's compare that to a hypothetical option trade. So let's say we bought the 30-day 150 call option for $5, and with the stock price at $160, 30 days later, we sold that call option for $10.
So this would be an at the money option, right? So if it's currently at $150 and you're buying the calls at $150, that's the at the money trade. Okay. So it's going to have a little bit different on the leverage there.
Now, the profit on that trade would be $500 because the option price increased $5 from where we purchased it. Now, remember, a standard option contract has a contract multiplier of 100, so that $5 increase in the option price actually represents a $500 profit. Now, since we paid $500 for that option and we sold it for $1,000, our return is 100%. So clearly, you can see that by trading an option, you can leverage your returns immensely relative to just a simple stock trade.
For sure. Now, let's take that. And let's go back to these, and let's say that it's $250 now, right? And we bought 100 shares. So this times this, okay? And same thing here, right? Let me format that. Now, let's say that it went up $5, okay? So it went to $255, but this one's also going to go up $5, give or take. We're rounding here, equals this plus 5, okay? Now we multiply this times 100. That's 25,500, right? Which sounds great, but our gain on that is new. This is how I remember it. New minus old divided by old. Okay, 2%. Or if this goes up $5, that is this times 100. Yeah, that's a 28% gain there, right? Because the option contract went from 1770 to 2270 here in this case. And so if we sold it out to close, we would have 2270, and that would be a 28% gain rather than a 2% gain, right? So you're paying 90% less and you're getting 10, 15x more return than you would just in the stock alone. I mean, the reasons for having options add up really quick.
Now, unfortunately, it's not all good news when trading options, because if the stock price had stayed right at $150 over that 30-day period, then the trader would have lost the entire $500 investment in that.
If, and I'm glad that we're having examples here, if it doesn't go anywhere and he bought it for all extrinsic value, right? So in this case, it would be the 255 strike here, which is 377 today. And all of that's extrinsic value. Extrinsic value goes to zero on every option contract, on every stock, every time at expiration. Okay. If this goes to zero and it's all you bought was extrinsic, then it is worthless, right? It's not worth less than it was the other day. It's worthless, right? Worth zero. Whereas if you go deep in the money, where I like to go in the 80s here, 80 delta, right? That's $2 of extrinsic on 1790, which is 2 divided by 17.90, 11% of it will decay to zero, right? Do you see the difference as to why I would go with the in the money, right? Because if it does decay to zero, and there's every chance that it could, if it does decay to zero, this option, as he was talking about here, at the money, slightly out of the money, has no value. However, on my option contract, I still have 90% of my value. Okay. That's the reason I do that. Now, I may not get 100% returns every time. Okay. But I'm still getting the $5 gain, right? If this option is moving $5, I'm still capturing that, even though I'm in the money, deep in the money versus at the money. But I have less risk in that case if it turns the other way. Hey, Peter.
That option. So now that you've seen the power of options and why they can be so appealing, we need to get you up to speed on the essential concepts that you need to understand before actually starting to trade options. Now stay with me because we're going to go in depth and explain both of the option types. So the first option type is a call option. Now a call option gives buyers the right to buy 100 shares of stock per contract at the option strike price before the option expires.
I've heard people liken this to coupons, right? So for example, I can buy 100 shares of Apple for $17.80 rather than $235, right? It's essentially a coupon for a huge discount. That's a good representation of that.
So let's go ahead and look at some examples of call options and strike prices. So if a call option has a strike price of 100, that means that the call buyer has the right to buy 100 shares of stock for $100 a share before the call expires. At $110 being the strike price, the call buyer has the right to buy 100 shares of stock for $110 a share before the option expires. And at $120, the call buyer has the right to buy 100 shares of stock for $120 a share before the call expires if they so choose to. Now, logically, it would make sense that buying shares at lower prices would be more favorable to buying shares at higher prices. So why not buy the call option with the lowest strike price? Well, the answer is that calls at lower strike prices cost more money for two reasons. The first being that there's...
Right. So in my example here, right, this one out of the money is $3. This one deep in the money that I like to trade instead is $17. Big difference.
more value in the ability to buy shares at lower prices, which is the strike price of the call. And the second reason is that calls at lower strike prices have a higher probability of being valuable at expiration. So if we go back and look,
which I would much rather have a higher likelihood of this being valuable at expiration versus worth zero at expiration. Just saying.
At the option prices at each strike, let's say the stock price is currently at $100 and we look at the call option with the strike price of $100. That option might be worth $3.50 and the call with the strike price of $110 might be worth 63 cents, while the call at the strike price of $120 might be worth 6 cents. So let's go over a more specific call option trade example so you can better understand how the position would work out in certain scenarios. So let's say we have a stock and the price is currently at $50. And let's say a trader's prediction is that the share price will increase to $60 in 2 months. Now, the hypothetical option trade would be to buy the 50 call that expires in 60 days. And let's say we buy that call for $5. Now,
so again, the at the money strike is what he's talking about here.
Based on the stock price in 60 days, let's look at the P&L of that position. Now, if the company goes out of business and the stock price is $0 in 60 days, then the P&L of that call option would be a $500 loss. Now, that's because that call option would expire worthless since the stock price is below the call's strike price at expiration. Now, let's say the stock price...
anything below $50 and less, it's worthless at expiration. Oh, Mikey Mike had a great question. What is deep in the money? Okay, so here is this line right here. Every broker platform is going to have some sort of line to show you where the moneyness is. And so that's the at the money, right? Anywhere around here is at the money. Any of these 4 strikes is at the money. Deep in the money is where it's deeper the option has intrinsic value. So in this case here, 250, 245, 240, anything below 250 is in the money. Deep in the money is relative, right? Deep in the money for me is roughly 80 delta. Deep in the money for someone else, maybe a 65 delta, right? But deep in the money generally is somewhere in the moneyness. Out of the money means anything that's a higher price than the current price, right? So if it's 250.63, if there were a 251 strike, that's still out of the money, whereas a 250 strike is in the money. Okay. Now, deep out of the money or far out of the money is another way to hear it. That'll be anywhere somewhere out here where it's like 20 delta or less, give or take. And deltas go from 0 to 100, right? And so you can think of it in percentage terms, right? How far in the money or how far out of the money it is when you say on a 0 to 100 scale. So so out of the money would be down here, in the money would be up here, deep in the money would be somewhere, 75 grade or greater on the delta scale.
Didn't move at all, and it was still at $50 in 60 days. In that case, we would still lose $500 because at $50 per share, that 50 call option does not have any value because the stock price is not above that call's strike price. So again, we would lose $500 if the stock price did not move over that 60-day period. Now, if the stock price increased to $55 and was at $55 at the time of that call's expiration, then we would not have a profit or loss on the trade because the call option would be worth $5.
So let's do the math behind this. The option was the 50 strike. Okay. And at the 50 strike, he paid $5 for it. So you take the strike price plus the amount you paid for it to get your break-even point. Okay. If he had paid 50 cents for it, it would have been $50.50. But the break-even here is exactly the strike price plus what he paid for it, which is why it's all the way up at $55.
And since we purchased it for $5, there would not be a profit or loss on that position. Now that call option would be worth $5 because with the stock price at $55, that call option has the ability to buy shares $5 below the current stock price, which explains why the call option is worth $5. Now, if the stock price were to rise to $60 over that 60-day period, the profit on that call option would be $500 because that call would be worth $10.
Now remember, this is the 50 strike. The 50 strike breaks even at 55 because it's the strike plus what he paid for it. So in order to make 500, it actually has to go all the way up to $60. Okay. So it's 500 more than what he paid for it.
Now the call would be worth $10 because the strike price is 50 and the stock price is at $60, which means that call option has the ability to buy shares $10 below the current market price. And that explains exactly why the call option is worth $10. Now remember, since that option contract multiplier is 100, the $5 increase in the option price from $5 to $10 equates to a profit of $500 per call contract. And finally, if the stock price were to increase to $65, that 50 call would be worth $15, which would represent a profit of $1,000 per call contract. Now, just to hammer home this concept one last time, that 50 call option would be worth $15 with the stock price at $65, because with the stock price at $65, that 50 call option has the ability to buy shares $15 lower than the current market price, which explains why the call option is worth $15 per contract. Now, when we compare buying the call option to buying 100 shares of stock, we can see that when the stock price decreases significantly, the loss on the shares is far more significant than the loss on the call option. However, if the stock price stays the same and does not increase,
and I want to show you why. Because call options have this asymmetrical risk and return, right? Because that's not what I wanted. I wanted something bigger. This will do. Okay, so you're only paying 500 for it. So the most you could lose is 500, right? But in theory, you have an infinite amount of gain. Okay, so what he's saying here is that if the shares go to 0, yeah, you can lose way more, right? But realistically speaking, if you're watching your risk, you're not going to have that happen. But that's how he can only lose 500, whereas the shares could lose all of the value of 5,000.
Increase, we'll have some losses on that call option, whereas the stock position won't have any losses at all. Now, when the stock price increases significantly, we can see that the P&L on the stock position is actually a little bit higher than the call option's profitability. But in terms of return on investment, you'll have a far greater percentage return on investment when you look at the call option compared to that stock position. And that's because to buy 100 shares of a $50 stock, you have to put up $5,000, whereas in this example, you only needed $500 to get similar profitability. So that's an example of how buying a call option can work out, but call options can also be sold, which turns the position into a bearish trade.
I don't want to teach you about selling call options. because it is an exceptionally dangerous game. Let me show you what I mean. So a short call option looks like this, right? So let's say you sell something out of the money. Let's say it's the Apple. It's currently $2.50, and let's say you are selling the 265s for $1.15. All right, you're going to collect $1.15 back, right? The most you can make is $1.15, right? Because we've taken what it used to look like, right? We've taken what it used to look like and we flipped it upside down. Okay, so now the most you can make is $115, whereas before in this example, the most you could have lost is $115. However, the losses can go on exponentially. Well, maybe not. It would be linear actually, but indefinitely. Okay. And I don't want you to have that happen, right? I've done that. I've made the mistakes. I've done this, and people are going to sell you a bill of goods saying, you know what? When you sell something that's out of the money at the 16 delta, that means only 16% of the time will you lose money in this, right? The other 84% of the time you're going to make money, which sounds great on paper. It sounds stellar, and I fell for it. But when you lose that one, when you lose the one time out of 10, maybe 2 times out of 10, it is going to be so much more than it is worth, right? You may be losing 10x on one trade compared to what you would have made, okay? So you need 10 in a row to be right in order to make up for the one loss. So I'll let them go on, but I want to preface this and say, don't sell options. Don't sell options because it is a sucker's game. They want to suck you into thinking a high win rate scenario is going to work out. And I bet you he does too, because actually I know Chris. I've talked to him multiple times. And this may be how he traded 6 years ago, I'm guessing. So he may try and convince you selling call options is the way to go, but I'm telling you, your risk return does not make up for it, even with an 84% win rate. So let's see what Chris has to say.
Trade. So let's go ahead and look at an example to see what that might look like. So let's say we're looking at a stock that's trading around $100, and we go ahead and sell the call option with a strike price of $110, and we collect $5.
Oh, Randy says they consider out of the money options as lotto plays. Yeah, a lot of people do, right? I consider selling out of the money options, and you've probably heard this term before, picking up nickels in front of a steamroller, right? Yeah, it sounds great. I'm going to pick up tons of nickels. But at some point, the steamroller is going to roll me all the way over. There have been countless times where people have blown up big because of this style of trading.
Dollars for that option. Now, if after selling that call option, the stock price trades sideways, decreases, or even increases slightly, the position will work out favorably because that call option will expire worthless as long as the stock price is below the strike price of $110 at expiration.
So, for example, if we go back to this, if at January 17th, the price of Apple is below 265, anywhere below 265, you get to keep the premium that you sold it for, which in this case is, let's call it $1 for rounding sake. We'll call it $1.10. Okay.
However, if the stock price increases significantly, then selling that call option could turn out to be a very dangerous play because there's no limit to how much.
If you sell that call option, it could turn into financial devastation, right? Not only are you going to put up $22,000 in capital to sell the call option, give or take, but then you're also going to, lose money hand over fist just to collect a measly $110. No.
A stock's price can increase, and therefore there's theoretically unlimited loss potential when selling call options. So let's go ahead and look at the hypothetical profit and loss of this position based on various stock prices at the time of expiration. So if the stock price ended up increasing to $200 per share, which would be a monstrous move, the loss from selling that call would be $8,500 per call contract. Now that's because with the stock price at $200, that 110 call is going to be worth $90 because it has the ability to buy shares of stock $90 below the stock price. And since we sold it for $5, that means we'd have a loss of $85 per call contract. And with the option contract multiplier of 100, the loss would be $8,500 per call that was sold. Now, if the stock price was right at $115 per share at expiration, there would be no profit or loss on that call position because since we sold the call option for $5, the call option would be worth $5 if the stock price was at $115 because as you know, with the stock price at $115, there's $5 of value in being able to buy shares of stock $5 below the current market price. Now, of course, if the stock price is at or below the strike price of 110 at expiration, then that 110 call will not have any value and it will be worth $0 or worthless at expiration. Now, of course, if you sell an option for $5 and it expires worthless, then your profit will be $5 per option contract, which in actual profit terms is $500 because of that $100 contract multiplier that we talked about earlier. So now that we've talked extensively about call options, it's time to get into the second option type, which is a put option.
Okay, so I'm glad that he did talk about the risk behind that because it's so important, right? So we're going to move from the left side of the option chain over to the right-hand side, which is where the puts are at. Now, the puts, if I had to give you a nutshell definition of it, is a put increases in value as the price of a stock goes down. Okay, so super easy definition. But to somebody who's new to the market, realizing that you can profit on the price going down is a foreign concept for a lot of people. I would guess 80% of market participants don't understand how to use put options to their advantage here.
Now, a put option is basically the exact opposite of a call option because a put option gives the buyer the right to sell 100 shares of stock per put contract at the put's strike price before the put expires. So, for example, if we have a put with a strike price of $75, that option holder has the right to sell 100 shares of stock per put for $75 a share before the put expires. Now, if you buy a put with a strike price of $80, you have a right to sell 100 shares of stock per put for $80 a share before the put expires. And if you buy a put with a strike price of $85, you have the right to sell 100 shares of stock per put for $85 a share before the put expires. Now, as you might have guessed, this is exactly the opposite of call options because put options gain value when the stock price falls as the ability to sell shares at the put's strike price becomes more and more valuable as the share price decreases. So with put options, as the stock price decreases, the put options value will increase. So to illustrate why this makes sense, let's go ahead and look at an example. So let's say we have a put option with a strike price of $85. If the stock price is at $80, the 85 put will be worth at least $5 because the ability to sell shares $5 above the current market price is worth $5 per share. However, if the stock price decreases from $80 to, let's say, $70, then that 85 put will be worth at least $15 because the ability to sell shares of stock $15 higher than the current market price is worth $15 per share at a minimum. So as we did with call options, let's go through a trade example, and this time we'll use put options. So let's say the stock price is currently at $200, and let's say the trader's prediction is that the stock price is going to fall to $190 per share sometime over the next 30 days. So the trade we're going to look at is buying the 200 put that expires in 30 days, and we're paying $6.50 for that put. So basically,
right. So again, the at the money put, it can be in the money, it can be at the money, it can be out of the money. Right. As long as you're buying the put, you have a bearish stance on the trade.
on this trade, let's go and look at the P&L of the put position based on various stock prices 30 days later. So in the first scenario, let's say the stock price increases to $250 in 30 days, quite opposite of the trader's prediction. In this scenario, the put P&L would be a loss of $650 per put contract because that put option would expire worthless, and since it was purchased for $6.
Right. Now remember, when you buy an option, the most you can lose is what you paid for it, right? So if the price had gone from 200 to 250 and you sold the option, it would be exceptionally more that you would be losing than just the $6, right? Significantly more.
$6.50, the loss on that option.
If you were selling calls, right? Because selling calls is a bearish trade. If you sold puts and it went from 200 to 250, you'd actually be up, but we're not discussing that right now.
Option contract is $6.50 times that $100 contract multiplier, which comes out to a loss of $650. Now remember, that put is worthless because with the stock price at $250, there's no value in being able to sell shares at $200. Now, if the stock price stayed the same and was right at $200 30 days later, we would also lose $650 because there's no value in using that put option to sell shares of stock for $200 a share since the share price is already at $200 a share. So in that case,
so Mikey Mike asks, so then we're looking for downward trend. Absolutely, right?
There's no value in the
10 under the 20, price under the 50, with market breadth also pushing down to be looking to buy puts. I have not bought puts in 2024. It doesn't look like I will be buying puts at all in 2024. It's been a while. I think it's been since 2022 I've bought puts because this trend has been ultra strong, right? I believe we talked about it in this time frame here. But for one reason or another, we didn't. I don't remember what the case was. And then you can see all of 2024. It's basically all of 2024. The market's been up, and it's up like 30 something %, which gives me a lot of anxiety, right? 30 something percent on an annual move sounds amazing, sounds fantastic. However, also sounds, if you think of it broadly, being 3 times as high as the normal year, right? It's between 8 to 10%. That makes me nervous to see if there is a correction, how steep that correction could be. Go back to the video.
Option, and therefore it will expire worthless. Now, if the stock price decreased by $5 to $195 per share over that 30-day period, then the put option with a strike price of $200 would be worth $5. Now, that's because with the stock price at $195, we have $5 of value being able to sell shares of stock $5 above the current market price. But since we purchased the put for $6.50 and at expiration it was only worth $5, we would lose $150 per put contract. Now, if the stock price decreases to $190, then we would have a profit of $350 per put contract, since that 200 put is going to be worth $10 and we purchased it for $6.50. Now, that put contract is going to be worth $10 because with the stock price at $190, there's $10 of value in being able to sell shares of stock $10 higher than the current stock price, which explains the put's value of $10. And lastly, if the stock price fell dramatically to $175 per share, that put would be worth $25 because there's $25 of value in being able to sell shares at $200 when the stock price is at $175. And with a put contract being worth $25, we would have a profit of $1,850 per put contract since we purchased it for $6.50 and it increased to $25. Now, just like call options, put options can also be sold, and that turns the trade into a bullish position.
So now, on this is where I screwed up a lot, because in a big bull market trend like this, right, a lot of people, and they probably have been doing it with all these 0 DTE options, have been selling puts against this, right? When you sell a put, it's a bullish trade, but you get to sell it for a decent amount out of the money. Let's go to the SPY option chain, and let's go to like the January 17s. And if the current price of SPY is 606, and let's say I want to go to the 20 delta, I could sell the 587s. So as long as it doesn't go under 587, right, which is 606 to 587, let's call it $20 or so. As long as it stays within a $20 range or higher, anything higher, right, then I get to collect all of that premium, okay? And a lot of people want to do that on 0 DTE options, which I think is a very, very dangerous game. So let's go on one that expires tomorrow to the 20 delta, which is going to be a lot closer. And let's say it's a 603, right? So now I've only got $3 of room to be right or wrong, right? To be wherever it's going to be or higher. But I'm only going to collect 25 cents. If I'm only collecting 25 cents and I don't sell anything with or buy anything with this to make it a spread beyond the scope of what we're talking about here. But if I don't make it a spread, I'm going to be putting up something like 10 grand, maybe $15,000, $20,000 for 25 cents. Yeah, people do that. Seems crazy, but they do. On top of that, let's say we do spread it out for a $5 spread, right? I would be making 21 cents. So $5 minus minus 21. So I would make $21 for every 479 that I risk, right? So that risk return is so imbalanced, which is exactly what happened to me, that it would take significantly. How many trades would that take, right? If I lost on one trade, if I lost all $5 of this, so 479 divided by 21, it would take me 22 trades to make back. 22 trades to make back on losing one. If I lose one trade, it takes me 22 trades perfectly executed to make it back. That is why I say don't sell options. Don't sell options. The risk return is so skewed against you. It is a sucker's bet. And I was that sucker for several years, right? That was what prompted me, because I did the math and I'm like, it's going to take me 22 trades to make up for this. That's when I was like, I need to find people who actually made money in the market, and super blessed beyond belief that I actually worked directly with 5 of the market wizards who taught me this is not it, right? Steve especially said, I used to trade like that, but then I realized I wanted to make money. That was the quote he told me. He probably doesn't even remember it, but I remember it, and I'll take it to my grave. I used to trade like that, but I realized I wanted to make money. I was like, oof, I am so far off. I need to shut up and listen.
So let's go ahead and look at an example just to illustrate how that would work. So let's look at a stock that is currently trading at $190, and instead of buying a put, we actually sell the 170 put and we collect $7 for selling that put. Now, it doesn't matter if the stock price trades sideways, increases, or even decreases slightly. At expiration, if the stock price is above that strike price of $170, that 170 put is going to expire worthless, in which case we will make $700. Now, with that being said, selling a put option is a highly risky strategy. Let's say the stock price decreased to $150. If the stock price is at $150 at expiration, that 170 put is going to be worth $20. Now, since we sold it for $7 and it rise to $20, the loss would be $1,300 per put contract. Now, we've covered a ton of content in this video, so let's go ahead and recap what we've learned so far. So let's start with call options. Now, when you buy a call option, that gives you the right to buy 100 shares per call at the strike price on or before the call's expiration date. Now, as a call buyer, you want the stock price to increase as much as possible above the call's strike price, as the call's ability to buy shares at a discount to the current share price will become more and more valuable as the stock price increases. Now, if you sell a call option, that actually gives you the obligation to sell 100 shares of stock per call contract at the strike price if a call buyer exercises and you are assigned. Now, I know we didn't talk about that in this video, but we did a full playlist on options trading basics, and one of those videos is on exercise and assignment, which dives deep into exercise and assignment and teaches you everything you need to know about those two concepts. Now, I highly suggest you click on that playlist link that is in the description, as it'll cover the most important concepts you need to know as an options trading beginner. All right, now moving on. Now, as a call seller, you want the stock price to remain below the call's strike price as time passes, as the option will expire worthless if the stock price is below the call's strike price at expiration. And as we've seen, that means you will keep 100% of the premium that you collected for selling that call option. So moving on to put options. When you buy a put option, that gives you the right to sell 100 shares of stock per put at the strike price on or before the put's expiration date. Now, as a put buyer, you want the stock price to decrease as much as possible below the put strike price, as the put's ability to sell shares at a premium to the current share price will become more and more valuable. So the further that stock price sinks below that put strike price, the more valuable that put option will be, which as a put buyer means that you'll generate more and more profits as that stock price decreases. Now, as a put seller, you actually have the obligation to buy 100 shares of stock per put at the strike price if a put buyer exercises and you are assigned. Now, lastly, as a put seller, you want the stock price to remain above the put strike price as time passes, as the option will expire worthless if that stock price is above the put strike price at expiration. And if that's the case, then you will keep 100% of the option premium collected for selling that put option. By the way, if you're brand new to the channel, please go ahead and click this.
Yeah, exactly. So I'm actually going to give this video like a 9 out of 10 because he covered a lot on this, right? He covered the basics. He covered what they are, the differences between buying one and selling one, the objectives between buying one and selling one. All of that I can really get on with. And I even appreciate the fact, because I know Chris Butler, not personally, but I mean, we've chatted before a couple times. I appreciate the fact that he also talked about the risks involved with selling calls or selling puts, because it's tremendously more risk to sell an option than it is to buy an option, right? Tremendously more profitable if the trade works out for you if you buy the option, tremendously more risk if you sell the option versus buy the option. So absolutely a ton of really good information here. So listen, we don't get winners all the time. So I'm glad we got that. That one was definitely outlier approved. Peter says he's going to review this, and Randy says, yeah, he did cover the basics well. I agree. So if that was useful to you, make sure you share that with somebody, and let's do our member highlight of the day. All right, member highlight. Mikey Mike, I'm hoping that you removes your email on that one. But Mikey Mike can put his email out in the Discord, and I was like, hey man, why don't you delete that message? I don't want anybody emailing you when they see it. But not a whole lot going on in the chat except for Michael Wales being the whale of the day, taking 11.75% out of Walmart. Way to go. And then Dave made 137% on QTBS. So congratulations, you two. I really am excited to hear those great things for you. So be sure to share your stories in the Discord and tell everybody you know about OVTLYR as well. But if you haven't already subscribed, do so already, but be sure to hit that like button. Now back to trading in the OVTLYR Trading Room. So I'm a partner with OVTLYR, and this is my style of trading using OVTLYR. Now real quick, what is OVTLYR? How does it work? It's the world's best AI stock trading assistant, allowing you to save time, make money, and start winning with less risk in a 4-step process. Number one, OVTLYR monitors how investors are reacting to changing market conditions, news, price movements, and the economy. OVTLYR determines if investors are acting irrationally fearful or greedy, and by how much. OVTLYR gives buy and sell signals when those irrational behaviors reach an extreme. Number 4, allowing you to get into the stock move before the OVTLYR move happens. Get into the stock before the OVTLYR move happens. Now, as you know, we have been sitting on a sell signal on the SPY for a while now, since November 21st. And during that time, the SPY has been climbing, but yet it seems to have reached a short-term high here, right? This shaded area is what we call an order block. This is where big institutional orders are waiting to be filled. This order block can be considered support and resistance, right? So anytime you have an order block up on top of your stock price, it's going to take a lot of work to churn through all those orders, to fill all those buys, fill all those sells, and then move out and continue on. So that's why that would be overhead resistance. Now, it's still inside of that order block, but when it closes over, the order block will disappear. But if it doesn't close over and it goes down, which there's a good chance, in my opinion, it could go down, that could be problematic here. Now, why do I say there's a good chance that it could go down? Well, if you look at OVTLYR in the market breadth, you can see here that there are 40 new names on the sell list today, only 2 new names on the buy list today. And we have that represented here in the market breadth section of the website here. And this green line is the number of stocks, right, from 0 to 100 of how many have a buy signal. As you can see, that's been just going down hard and fast with the 10 EMA crossover happening on December 4th. So the market breadth is super weak. We've got a sell signal on the SPY, and yet the market is still flirting with new all-time highs. Where I'm really concerned is if you look at an S&P 500 map over last week, I was trying to find for month to date. That's what I'd really like to see. By the way, year to date is crazy. Look at these numbers. Amazon 53%, Tesla 85%, Microsoft 20, 166 on Nvidia. These numbers are crazy. But going back to the last week, this is why the market is really, in my opinion, in a dangerous situation. A handful of stocks, a magnificent 7, pretty much, with a handful of others, are the only ones holding up the market. Everything else is super red. Super red. Everywhere else except for 1, 2, 3, 4, 5, 6, 7. That's scary, right? Because of that, I think we are absolutely ripe for a pullback. Now, I don't know when that's going to happen, but I don't have to worry about it, right? Because I'm using the data that I have, right? The market breadth showing weakness, the sell signal on the SPY, right? And while the market may be continuing higher in a bullish trend, I think this is a super weak bullish trend that, I don't know, could be some Christmas shenanigans come through here very soon. But for me, I won't be trading any today, and I know that my trading plan won't have me trading at all for the rest of the year. But I do want to encourage you to go into OVTLYR, see what new trades are working for you. As you can see, we've got members who are still making money almost every single day, it looks like, by using our data here. So thank you so much for being an OVTLYR and for coming to the OVTLYR Trading Room. Be sure you come back tomorrow. We want to help you every single day by helping you save time, make money, and start winning with less risk together as a team. This Thursday, we will be having the trading room at a different time. It's going to be about an hour earlier. It will be starting at 2 p.m. Eastern time, 1 p.m. Central time. So be sure to check your calendars for this Thursday. As Randy noticed, yeah, NVIDIA is no longer holding the market up. We go to the map here. NVIDIA is down 4.84% in the last week. If we look at the chart, yeah, NVIDIA's, I mean, it's below its 50-day at this point. It's looking really, really rough. And you can see these order blocks here. This is a great example of an order block, right? It created this order block on November 7th, this one above, the purple box. It went up, flirted with it, came back down. Went up, flirted with it, came back down. Went up a third time, flirted with it, and came back down, right? This is what overhead resistance looks like. Now, you may be finding support here as well because you've got a double stacked order block down here. But to Randy's point, the market, the S&P 500 is a market cap weighted index. And if you've got big names like this, they will hold the market back, right? NVIDIA down 4.84% is going to hold the market back, whereas Google and Tesla, being that they are also big, the bigger these are, the bigger market cap they are, is going to be helping prop up NVIDIA in this case here, which is the point of an index. I get that, but it makes me really nervous. So that's going to wrap it for me. Be sure to get the annual plan for just 90 cents a day. That does end at the end of the month. Let us know if you need anything and tell everybody you know about it. And if you haven't hit the like button already, do so, right? We're trying to cover as much as we can, teach you and make you as smart as you can for the next time you start trading. Have a fantastic afternoon. See you right back here tomorrow. Talk soon.